Good evening, everyone, and welcome. I'm Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our discussion today on CV financing. Use CVs Marching Ahead. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Umesh Revankar, Executive Vice Chairman, Shriram Finance Limited, Mr. Anil Bhavnani, Senior Executive Vice President, HDFC Bank Limited, and Ms. K. Vasumathi Devi, Managing Director, IKF Finance Limited. The session will be moderated by Sanjay Agarwal, Senior Director, CareEdge Ratings. We will commence this session with a presentation by Ravi Shankar R, Associate Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of any queries, participants are requested to key in their panel. We will take up your queries during the panel discussion session. Now, may I invite Ravi Shankar R to make his presentation, please?
Yeah, thank you, Divya, for the introduction. And good evening, everybody. Once again, I welcome you all to the Care Ratings webinar on commercial vehicle financing. Use CV Marching Ahead. In this presentation, we will look at the industry trends, performance of CV financing NBFCs, and the way forward for the industry. Let us look at the industry performance first. Commercial vehicle sector AUM growth rate, which has dipped to 6% in FY20, as seen in the dark line in chart from its high levels of 25% in FY19, was due to multiple macro issues such as change in axle norms and change in emission norms from BS4 to BS6. AUM growth continued to remain low at 6% in FY21 and 7% in FY22. Lower growth in these 2 years can be attributed to the COVID-19 pandemic. The growth rate bounced back to 12% in FY23 with support from growth in new CV sales volume. It is to be noted that the new CV sales volume was at the peak level in FY19 and the industry is yet to reach the peak levels. With degrowth in CV sales volume in FY20, the AUM growth rate for CV financing was majorly contributed by the used CV financing and lower rundown in the AUM during the COVID period due to moratorium and restructuring. Based on the samples considered by CareEdge, the CV sector AUM stands at around rupees 4.01 lakh crore as on March 31, 2023. Banks and captives largely dominate the lending in the new CV segment, while NBFCs have a lion's share of the used CV financing pie. When we split the overall AUM into banks, NBFCs, and captives, the growth of NBFCs are more consistent than banks and captives. Banks, NBFCs, and captives account for 40%, 43%, and 17% of the market share, respectively, as on March 31, 2023. In terms of new CV financing, market share lost by captives was gained by the banks. However, the share of NBFCs has increased due to higher growth in used CV financing. NBFCs show consistent growth as they focus on used CV, whereas banks and captives are more volatile in line with the new CV sales volume. Observations from historical trend suggest that the growth of the sector primarily depend upon the sales volume in the CV industry, which in turn is again directly correlated to the economic growth. Disbursement was at the peak level of around 1.2 lakh crore during FY19, as the new CV sales volume was at the peak during the same period. Even before the COVID-19 pandemic, the domestic CV sales was adversely impacted during FY20 due to regulatory changes and the macroeconomic situation. The impact was compounded even more by the COVID-19 led lockdown in FY21 and 22. This is clearly seen in the disbursement chart shown here. As stated earlier, though the disbursement declined during the COVID period, the rundown was lower in AUM due to moratorium and restructuring benefits offered. The disbursement rebounded in FY23. However, the overall disbursement on absolute basis is still lower than the levels of FY19. The used CV segment is largely dominated by NBFCs and it shows a steady trend in AUM growth as shown in the dark line in the chart on the right. Whereas the new CV segment is volatile in line with the CV sales volume. The market share of used CVs within the NBFC AUM has increased from 42% as on March 31, 2019 to 56% as on March 31, 2023. It is to be noted that the data for NBFCs include captive NBFCs as well. Used CV is typically 30% lower in terms of price. Also, the used CV financing is done for a tenor of 3 to 4 years, interest rate of 14 to 24%, and LTV of around 80% on the grid value of the vehicle. The major drivers for the growth in used CV financing are relatively lower price than the new vehicles, emergence of organized marketplace for the purchase of used vehicles, and better financing options available in the market. Now let us move on to the performance of CV NBFCs based on sample considered by CARE, including the captive financiers. Gross NPA ratios of the sector improved in FY21 as seen from the chart despite the pandemic, as the NBFCs benefited from regulatory measures such as extension of moratorium to borrowers and restructure of borrower loans, which actually delayed the recognition of NPAs. However, the sector witnessed an uptick in GNPA levels during FY22 as seen in the chart. The three factors leading to increased NPAs were second wave of COVID-19, which had a fresh round of statewide lockdowns. 2. Increased slippages from the restructured book with actual crystallization of the stress which is there on the loan book. And 3. The implementation of IRACP norms, wherein the NPA classification was moved to a day-end basis instead of a month-end basis. GNPA levels improved as on March 31, 2023, with growth in loan portfolio and improvement in collection mechanism in some of the NBFCs. The sector has seen a steady improvement in capitalization levels, with NBFCs raising capital during COVID and growth remaining lower during the same period. The overall gearing has continuously come down from 6.1x as on March 31, 2019 to 4.8x as on March 31, 2023, as seen from the chart on the left. This provides room for higher growth going forward. Liquidity maintained on balance sheet had significantly increased from 4.3% as on March 31, 2019 to the peak level of 9.8% as on March 31, 2021, as seen from the chart on the right. However, post the second wave of COVID-19, cash and bank balance maintained reduced from the high levels of FY21 and remained at 5.8% as on March 31, 2023. NBFCs which had strong capital raising abilities reduced the liquidity maintained. Nevertheless, it still remains above the historic levels. Going forward, CARE rating expects the liquidity to remain at the current levels. Net interest margin improved during FY23 as seen in the grey line in chart on the left, with increase in yields driven by repricing of the new portfolio and increase in the proportion of used vehicle. Increase in the cost of borrowing could add to the pressure on NIMs during FY24. However, the same may be offset by improvement in the credit cost. As seen in the green line in chart on the right, credit cost, that is provisions and write-offs to average total assets, declined during FY23, which also resulted in improvement in ROTA. Now let us look at the way forward. CV industry is expected to continue its growth momentum in FY24 with moderate volume growth of 8 to 10%. The growth of CV financing NBFCs is also back on track. The growth rates are expected to be higher with good traction in the used CV financing as well. AUM growth rate of CV financing in NBFC is expected to be above 13% for FY24 and 12% for FY25. While overall AUM growth is expected to be in double digits, performance of players within the segment is likely to witness divergent trends, as few players would be constrained to focus on containing NPAs rather than the AUM growth. GNPA improved in FY23 with higher growth reported and improvement in collection mechanism in some of the NBFCs. GNPA is expected to improve going forward as the customers who are in NPA due to IRACP norms will complete the current cycle. Also, the growth over the next 2 years is expected to improve NPA ratios. However, NPA ratios will still remain moderate. As the NPA ratios improve, credit cost is also expected to improve going forward, as seen in the dark dotted line on the chart. The risk faced by the CV financing sector currently. Any cyclicality in the new CV sales volume has always impacted the sector. Over the last few years, the capital expenditure by the government has remained higher. If the government expenditure reduces, it is expected to have significant impact on the growth of CV financing sector. The industry also has the threat of technological changes, say such as emergence of electric vehicles. Say the industry requires time to understand the reliability of these changes before financing those vehicles. CV financing is typically a fixed rate loan, and any change in the interest rate cycle is expected to have an impact on the profitability. Also, the volatility of fuel prices, though it remained at the same levels for more than 2 years now, plays an important role both for the growth of the industry as well as on the repayment capacity of the customers. Let us look at the key takeaways from this presentation. CARE expects growth rate of CV financing NBFCs to remain high with increased growth coming from the used CV segment. While growth has kickstarted in line with the improving macroeconomic fundamentals, growth numbers are still below the historical peak levels. Margins are expected to be impacted with increase in the cost of borrowings. However, the same is expected to be offset by decrease in credit cost, which will enable to keep the profits intact. Asset quality is expected to remain moderate for the overall sector, though improvement is expected in the near term. That's the end of presentation. Thank you, and over to Divya.
Thank you, Ravi Shankar. As conveyed earlier, all attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Sanjay Agarwal to take over the session, please? Sanjay Agarwal, Senior Director at CareEdge Ratings, has 3 decades of experience in the field of ratings, banking, and infrastructure finance. Currently, Sanjay is heading the BFSI vertical of CareEdge Ratings. Prior to joining CareEdge, he has worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce and is a chartered accountant. He is also qualified as a grad CWA, a financial risk manager from GARP USA, and as a certified financial planner from FPSB India. Over to you, Sanjay.
Thank you, Divya. Thank you, Ravi Shankar, for the presentation. Good afternoon, everybody. Thanks a lot for joining for this webinar. We have 3 speakers, guest speakers for the day, 2 from the NBFC space and 1 from the banking sector. So in terms of the sector, we probably have among the best team that we could have for your discussions today. All the 3 speakers have immense experience in the CV financing space segment. So I'll introduce them. So we have Mr. Umesh Revankar. Mr. Umesh Revankar is the Executive Vice Chairman at Shriram Finance Limited. He has 3.5 decades of proven leadership experience in the financial services industry and is probably among the senior-most banker in this line of business. He has been associated with the Shriram Group for these 3.5 decades and has shouldered various responsibilities and has worked in key leadership roles in business operations. He is instrumental in Shriram Transport being India's largest commercial vehicle financer. And Mr. Revankar is the chairman of Finance Industry Development Council, which is the industry body for the NBFCs. He holds an MBA in finance from Mangalore University and has attended advanced management program at Harvard Business School. Welcome, sir, to this webinar. Our next speaker for the day is Mr. Anil Bhavnani. He is the Senior Executive Vice President and Head Transportation, Infra and Tractor Finance Group at HDFC Bank Limited. Mr. Bhavnani is an experienced professional banker with more than 2.5 decades of experience and a proven track record. He has been instrumental in creating leadership positions for HDFC Bank in various segments such as commercial vehicle, construction equipment, infrastructure financing, bank branching, etc. Prior to this, he's worked as the business head, Infrastructure Finance Group, and the head of business bank, rural banking in HDFC Bank. Welcome, Mr. Bhavnani, to this session. Our next guest speaker is Mrs. Vasumathi Devi Kognati, who is a Bachelor of Electronics and Bachelor of Engineering in Electronics and Communication, and an MBA in Global Management from US. She has about a decade experience in IT and telecommunication services in the US and has been associated with IKF as an ED since 2007 and as the managing director since 2022. She heads the overall vehicle financing business and specially focuses on credit systems and technology. She has been instrumental in expanding the operations of the company to the western and central parts of the country and also in upgradation of IT infrastructure and automation of various processes. Welcome, Mrs. Vasumathi, for this program. Now, as we move to the main session of the day for hearing the views of our esteemed guest speakers, to begin with, we would like to point out that the speaker that to this audience that this discussion is on the overall industry prospects of the CV financing industry and not on any individual companies the speakers would represent professionally. Hence, none of the views should be construed as the assessment of the individual company or bank where the speaker would be professionally associated. So we now begin with the question. So Mr. Anil Bhavnani first. What could be the likely growth in CV sales as well as disbursement for new CVs in the next 2 years? And which segments will drive that growth?
So thank you, Sanjay. And it's my pleasure today to, be a part of this webinar. See, I think governments, focus on, if you look at the current Indian economy, anywhere between 3.5 trillion, and which we're talking about 5 trillion. The credit growth rate that, GDP is supposed to grow at around 7.5% as per the, all the, analysts. So the credit growth rate is typically a multiple of 3. So 21%, 22% is what the credit growth rate will be in FY24 and FY25. Commercial vehicle, I think, is going to be a very, very vital role it will play in, the economy of a country. So if 2-3 things, which will drive the commercial vehicle industry in the next 2 years, as per me, one is, the replacement. So there'll be a lot of, we have this 10 years, 12 years, rules which are going to be applicable in many of the cities. So commercial vehicle more than 12 years and, 15 years will not be allowed. So one is a replacement vehicle. The other is, if India has to move from a 4 trillion to a 5 to 6 trillion economy, then the last mile movement of goods and services will only be done by commercial vehicle. So anything between, 12 to 15% is my take, should be the, the growth rate of commercial vehicle in the next 2 years. Obviously, with, political stability and the kind of infrastructure growth that we're looking at, I think this is an achievable number.
Okay, 12 to 15% is your take. And now we come to Mr. Revankar. The proportion for UCV has increased over the years. With already 4 years since the BS6 implementation, how do you see the growth panning out? And then how long do you see the trend continuing?
Thank you, Sanjay, for having me here today. See, the used vehicle numbers increase. There are multiple reasons in the overall portfolio. One is more formal players. In the sense, more NBFCs are getting into used commercial vehicle. Unlike in the past, most of the used vehicle financing was with the informal lenders, that is small NBFCs or the informal lenders who do not come into the database. Today, you can see most of the large NBFCs getting into their used vehicle financing, and we are leading. Shriram Finance is leading. And that's one reason you can see that pie increasing in used vehicle. And also the second reason is the ticket size is increasing. As rightly put it, the axle chain norm and the Bharat Stage 6, where the improvement in technology, that has improved the value of the vehicles, used vehicles. The resale price of typical used vehicles have gone up by around 25 to 30% on par with the new vehicle price increase. So the ticket size also has gone up in used vehicles. So prices that also determines the value of used vehicle going up in the overall pool. So I think this is going to continue for a while. At the same time, if you look at the size of the vehicle, the the maybe 10 years back, average vehicle carrying capacity as I'm an HCV used to be 17 ton. Today, on an average, they carry 30 tons. So, new vehicle sales number will be lesser over the period because the larger vehicle will be taking over what you call the more taking over the sale, and automatically number of vehicles sold will be little lesser. So we cannot compare with the previous years all the time. So overall, I feel the used vehicle numbers are increasing mainly because more formal lenders getting into the business, understanding the value and understanding the portfolio quality is on par with new vehicle.
Okay. So you're saying the market itself is increasing in the formal sector, and the tonnage is increasing. The number of vehicles may not increase since the same vehicles carry much higher tonnage.
Yeah.
Okay. So coming back to Mr. Anil Bhavnani, do you see a significant role for NBFC supporting banks in reaching and expanding customer access for the vehicle financing?
So, Sanjay, what is happening is obviously, see, India is a large country with 6 lakh plus villages. The last mile, delivery for, these kind of you have, and even in the commercial vehicle, you have this ultra light commercial vehicle, light commercial vehicle, medium heavy commercial vehicle. So, the last mile, which happens through the ultra light and light commercial vehicle. So, I think there are segments. So, the large fleet operators, when they look at commercial vehicle, they don't look at it as a standalone commercial vehicle financing. So these large customers, we provide them working capital, we provide them term loans, we give them the entire cash management, their collection mechanism, the payments, help them, the vendors through the vendor support. So we give them a 360 kind of for the entire basket of products. But when it comes to the small, a first-time buyer, first-time user, SRTO customers, buying a, 407 or, these, pick load small commercial vehicles, they call it SCV, some people call it pick and carry. So for that last mile, so we need to have all the players. So between NBFC and bank, I think, the entire chain will continue to be there. Each of us, have our own, dominance in those markets. So I think currently, like it operates, I don't think see a significant change will happen, as we go forward. I think the NBFCs will continue to be more relevant in the used and the small ticket sizes, and I think banks will continue to also keep penetrating in the used, but they'll be still dominating in the large and the medium fleet operators is my take.
Okay. So coming to Mrs. Vasumathi Devi now, ma'am, the used CV financing has been growing steadily, especially for the NBFCs over the past few years. So what are the drivers for this, other than what Mr. Revankar has said, what do you think are the drivers for the used CV sales by NBFCs? You are on mute right now. No, you are on mute, so I don't know who. Can you unmute it, host? Yeah, that's the, yeah, we can hear you.
Sorry, thank you, Sanjay ji, for having me on the panel. It's great to be on the panel with such industry stalwarts. So on the NBFC side, the last mile transportation is mostly done by the NBFCs, especially on the small and the light CV, and to some extent on the used CV too. The demand for that is growing because the vehicles are able to perform better. In a way, previously used vehicle used to have a cycle of two cycles, and the third cycle the repairs would go up, the fuel efficiencies would come down. With the new improvements in the mechanics of the vehicle, this has improved to such an extent that even on the third cycle, the efficiencies are there and the vehicles are performing better. That's why the demand for used vehicles has grown up. The other thing that happened is the price of new vehicles has gone up tremendously, which has increased the installment for the fleet operators are able to accommodate it, but especially in the SRTOs and the medium fleet operators, it is not as cost effective because they are transporting the same kind of tonnage and the freight rates are the same. So the efficiencies of an used vehicle or the viability on a used vehicle has improved compared to the new vehicle. That's why the demand for used vehicle I feel is going up on top of the government initiatives and the demand in the market and all that Mr. Revankar talked about.
Okay. Thanks. So we come to Mr. Revankar. The RBI circular in November 23 had said that top up for movable assets would be, which are inherently depreciating in nature, would be treated as unsecured loan for credit appraisal and prudential limits, etc. So what do you think would be the impact of this on the sector?
As it is, I don't see any impact, because what happens is normally no NBFCs offer a top-up loan on the existing loan. Maybe in the car loan and home loan, this practice is there, where the customer is a salaried person and he already has the salary account with the bank. They offer a top-up loan just because that is considered to be safe borrower. And NBFCs don't normally give top-up on the vehicle, which is depreciating. But our understanding of the circular is, if the top-up is more than the depreciation value, then only it will be considered as unsecured. Otherwise, it is not. So that's how we understand. And I don't see there is any negative implication because of that, because I don't see any NBFC offering any top-up loan for the beyond the depreciating value of the asset.
Okay, so you expect that given the practices of the NBFC industry, you don't see significant impact on the industry as well?
Yes.
Right. So we come to Mr. Anil Bhavnani. Banks are predominantly in the new CV space, as you said. So, but as Mr. Revankar had said, that new CV space has also become more organized and more formalized and all that. So, do you think banks will look into that segment in a meaningful manner?
Yeah. So Sanjay, I think as a strategy, if you ask me, and in all banks are looking, because see, the rate of interest, between a used and new is anywhere between 250 to 300 basis points is the difference, right? So if today whatever disbursements we do, only 5% of that is used, or maybe 3.5%, 4% is used. As we progress, and like all my other panelists are saying, because of the cost going up, so the new use is going to become a bigger and bigger market. So I think we will, as banks, will also participate, obviously keeping in mind the credit losses, keeping in mind the risk involved in the used. But definitely we will increase our pie. So our market share, will keep increasing as we progress. And for existing large customers, even today we do use. So it's not that banks don't do refinance and use vehicle financing. We are doing it. But as we progress, I think the pie will keep growing. And as part of bank, I think we will keep increasing our footprint on the used because of better rate of interest, and obviously keeping in mind the credit losses.
Okay, so with the increasing pie, probably the banks will have a larger share, but there will be more share for everyone.
Absolutely.
Okay. And coming to Vasumathi ma'am, what are the adoptions in credit assessment for used CV? Again, data availability and technology, how is all that helping in underwriting more efficiently?
So integration of technology has become a key function for the NBFCs to succeed these days. So NBFCs have a rich data of multiple years where the credit quality has been on these different vehicles across different geographies and different profiles. Leveraging the technology to underwrite better is helping us reduce our credit quality and improve our efficiency. We used to be a completely paper-based NBFC a long time ago. With using technology, developing models, understanding viability through the system, we are able to offer a better time and even improve our underwriting models based on the data that is coming from the collection. or from the quality of the portfolio that we have. So we feel these things are helping us scale faster and better.
Okay. So coming to Mr. Revankar, in terms of profitability, how do you see the CV financing segment? And what is the expectation in an environment of moderate asset quality and increasing cost of fund? How do you see the profitability in this segment?
The used vehicle normally gives better margins, as Anil rightly said it. There are different customer base. One is organized large fleet operator. There are medium fleet operator, small fleet operator. Then there are individual operators. The individual operators are definitely where is the margins are much better and profitability is much better. But at the same time, it is difficult for large banks to lend to small individual operator and have access to him. So the NBFCs will play a major role in lending to individual small operators and used vehicle. The margins are likely to be reasonably good. And I think the net interest margin in these segments should be anywhere between 4 to 8%, depending upon how the lending is done. At the same time, as Mrs. Vasumathi right now, she was telling about adoption of technology has helped all the players, in all the small and large NBFCs, to use the database, use the previous track record, use the public scores, credit scores of all the individual customer and lend to them. Underwriting quality and our underwriting standards have improved significantly. So credit cost has automatically come down, giving better ROA to the business. So ultimately, one is margin, keeping the margin safe, and improving a credit quality will help you to have a better what to call ROA in the business. And as far as the what to call the liability cost, borrowing cost is concerned, borrowing cost will keep varying from time to time, and accordingly we will be adjusting our lending rates. No NBFC would drop their margins for increasing their volume. I think most of the NBFCs would prefer to keep their margins safe, and the lending cost or lending rate will go up to the end customer, and the growth rate will moderate over the period. So we are not really, nobody would hurry to increase his business volume, prefer to keep the margin safe and grow moderately.
Okay. So you're saying profitability, you expect to remain in line with what is there right now, or probably better? So to the viewers, I'd like to just add on to what Revankar sir has said, that NIM between 4 to 8% would be in the business. But it also depends on the size of vehicle, etc., where the OPEX is significantly different depending on the asset class. So that would probably lead to a more uniform ROA than what the NIM would suggest. And that becomes very important, especially in the used vehicle business. Coming to Mr. Anil Bhavnani, so how do you see the market segmentation? This is what we've been discussing since some time now. In a couple of years, in terms of relative importance of large private sector banks, the PSUs, the captives, and the NBFC. So do you see the market segmentation moving anywhere, or you see that going as it is right now?
So I think, Sanjay, see, like I said, the last mile, and deeper geographies in terms of, rural markets, semi-urban rural markets, I think the NBFCs will continue to have the footprint there. The smaller, segment, which is your, SRTO, FTU, FTBs, and used NBFCs will continue. I think as we move, to the mid, large, and, people who need banking, requirements in terms of the entire supply chain, and so that will. So I don't see a major shift happening. yes, like I said, the use pie will keep increasing. They are better, net interest margin. And so that segment, as banks, we'll keep nibbling our share into that as the pie grows. So I don't see a major shift, happening. I think all, between banks and NBFCs will continue to have see, because commercial vehicle as a segment is, it's very, very important for the growth of the country. And the kind of focus that the government spends will have on this segment, the roads becoming better. I think all the players will have their share, and I don't see a significant change. It'll be, some basis point here and there, but I don't see a significant change as we progress.
Yeah, I think the question was more on the captives and the PSU banks. So do you see that share, because you've seen the share of captives gone down pretty sharply, and we don't have an estimate of share of PSU banks, but we estimate it won't be very large. So how do you see that
So you're saying captive NBFCs?
captive NBFCs and PSU banks?
Yeah. So PSU banks, see, what I've seen, of late, PSU banks, they don't have a very consistent, track record. Or, we see in some markets, suddenly some PSU bank doing, in the month of March and all that. But over a period of 12 months, see, like, we have players who are serious dominant players in this segment, and they continue to dominate. PSU's bank, keep in coming in some pockets, basis their strength in few pockets. Because see, this business also is not as, need to understand the nuances of this business. Like, you need to understand, how the freight rates move, the fuel prices. These are some of the variables, which is very important. So you need to understand this business if you have to underwrite this business, and then obviously collect the money from the customers, right? So you need to have a dedicated team, so like we have in the bank a dedicated team looking after this business. Shriram is, so the players who are, serious players and have a dedicated team, I think they will continue to have a dominance. People who just, have, there are some pockets, some branches of those PSU banks understand this business, you will see some of this thing, but on a pan-India level, they will not have a, significant role. And captive financiers, I think, it's always been, when other banks and NBFCs shy away, the captives, become, their shares always go up. So as soon as the other banks and NBFCs become, they become aggressive, I think the captive share go down. That's my personal take on it. I would on captive financing.
Okay. So, yeah, so we now move to Vasumathi, ma'am. So, in the presence of such large NBFCs and banks, how do you see the evolution of relative smaller players in the industry?
I feel the market is enough that there is pie for everybody to get. The other thing is, small NBFCs have the regional or the local knowledge that helps them. Also, smaller NBFCs also have niche segments they target rather than going by an overall model across all the geographies. There are some advantages to smaller NBFCs that they understand the local geography much better, even on a collection basis and an underwriting basis that helps them. But I think smaller NBFCs are also going to scale up, and with the market increasing at such a huge pace, there is potential available for everyone.
Yeah. So coming back to Anil Bhavnani, higher government capex has aid CV financing to grow at a good rate. So how much is the CV financing dependent on the capex of the government? Because we keep hearing stories of capex going down, the revenue, the deficits have to be managed, etc.
No, I completely disagree that capex is going to go down. If India has to become a 10 trillion economy, then, infrastructure development, road and highways are going to be one of those key. Even if you looked at the interim budget, which was presented by the finance minister, I think there was a big outlay on the infrastructure and road and highways. So I don't think so. This is a given. And any large city today, whether it is Bombay, Delhi, Bangalore, Pune, any large city, if you have to decongest, the only way you can decongest a large city is by doing two things. You have to have an elevated, road, and you need to have metros. If you have to make an elevated, road, then you need, your, trailers and trip trailers and, equipments, and you need piling and you need, cranes. So commercial vehicles are required. And if you need to build metro, obviously commercial vehicles are. So I don't think, anywhere, and this is tier one cities as big, large metros. As you move to tier two, tier three cities, so decongesting and, of roads and making the roads livable in India. I think infrastructure, road and highways is a given. And there is no way that capex, will government capex will get reduced. So at least I don't see that happening in the next 5 years to 10 years. I think there's a good long runway and a good story for this industry.
Okay. So there's another question, I think, between Revankar sir and Anil. You can both of you can take a shot at it. It's from the audience. Have the loan tenures in the CV financing gone up in the past few years, including the youth segment? Because what does that same explain the difference between the disbursement and the AUM growth trend?
Sorry, I didn't. Can you repeat the question, Sanjay?
So have the loan tenures in CV financing gone up in the past few years, including in youth CV financing?
Yeah.
Does that same explain the difference seen in the disbursement and AUM
So,
growth trend?
so if you look at it, my portfolio is more of new and less of used. So on the new, absolutely, we have seen earlier the average tenor used to be anywhere between 3 and 4, and now it has become 5, 4.5 to 5. So it's gone up from 3 to 4 to 4 to 5. So that's the change, and hence you're right. It does. So the tenors have gone up by at least 6 months to 12 months. That's
Okay,
what
Umesh,
we have seen in the last 2 years.
No, yeah, you're right. I think what Anil said is right, because the ticket size is going up, automatically the tenor has to go up. But because EMI cannot go up significantly immediately, so as a matter of time, it is slowly the tenor will increase, then the EMI will increase. So it is a mix and match.
Okay. So I think the other point is in the graph that we showed, the disbursement in the COVID years was much lower. There was a significant degrowth in the disbursement, but the AUM growth was still happening because also due to all the moratorium and all those things which was there provided by RBI for some time. So the rundown on the portfolio was much lower than what the normal, let's say, prepayment period would have indicated.
You're right. You're right.
And next question is from Mr. Revankar. Fuel prices have not increased in the last 2 years. Do you see any impact of that on the demand for vehicles, and does the quality of the book also get impacted by the fuel prices?
Yeah, fuel price actually in last 2 days it has come down by 2 rupees. It's good for the vehicle owners. Fuel price coming down gets them some additional margin for time being. But most of the pricing that freight prices get adjusted to fuel price, whether it goes up, and if it is coming down over the period, it will get reduced, is what I believe, because everybody has a gross margin in the mind, and as long as the demand for vehicle is high, utilization of asset is high, then the pricing power of the operator will be high, so his margin will be safe. Only when there is excess capacity and lower demand, in that situation only the challenge will be there. If the fuel price goes up, otherwise it's always good for the operator when there is always a demand for a vehicle. Today, most of the assets, most of the vehicles are running 24-25 days in a month, which is highest utilization level. Earlier, the maximum utilization level used to be 21-22 days in a month. So most of the vehicles are running in a high utilization level, plus the margins are quite good and healthy.
Okay. And a question for Mr. Anil Bhavnani. Do you see the emergence of EVs in the commercial vehicles, and as lenders, are you prepared to lend to this segment?
See, I think currently, if you look at it, the electric vehicle is, it's basically in the bus segment and in the ultra light commercial vehicle. These are two segments where we have seen the emergence of EV. So ultra LCVs, ultra light commercial vehicle, and the bus segment. And the battery cost, is the biggest cost for the the EV vehicles. So the capex, the first time capex, buying the vehicle is definitely higher, but obviously the OPEX is much lower. So it's a stage of evolution. I think with so much of talk on green and having zero carbon emission. So I think EV is definitely going to, all OEMs are looking at how to get EV. And as a, I think all the players will have to start. So we are all doing our bit in terms of financing EVs. But I think it's a journey which has just begun. We will have to see how things pan out, in the next couple of years. But I think if they have the strategy right, I think it's the way for future, because it'll play a significant role, and the shift will keep happening over the period. So yes, we have started doing EV financing in this small way, but it's to be seen how things pan out in the next couple of years.
So you're saying it's more of a testing and initial.
Yeah. But I think on the bus, so that's why I said these two segments we have seen some development. The bus segment is definitely seeing, and its things are getting stabilized there. And the ultra light commercial vehicle, I think it is getting stabilized. How things pan out in heavy and medium and heavy commercial vehicles is still to be seen.
Sanjay, here what happens is the battery weight is quite high. The battery weight is around 30% of the vehicle weight almost. So what happens is your carrying capacity comes down in a commercial vehicle. Therefore, unless the battery becomes light, it is unlikely that in commercial vehicle, the electric vehicle will come in a big way. It is going to be in only ultra light, as Anil rightly put it, and in the passenger vehicle where loading is less. So the one of the factor for the electric vehicle is unlikely to become popular in the commercial vehicle is because of that. I think CNG and LNG technology will play a more important role in the vehicles, in the commercial vehicle than electric vehicle, unless the battery become lighter.
Okay. So, sir, the another thing on the EVs is that as we had discussed in this webinar, that many of the vehicles will reach a end of the life, and then that will be replaced by new vehicles, etc. So, could there be a situation that these vehicles which have reached end of the life could probably then be used on batteries, because then the IC component would not be applicable out there? Mr. Revankar?
No, at the end of see in IC vehicle, as I was explaining you, the shifting from IC to the electric in a heavy commercial vehicle is going to be a challenge because of the battery weight. So it is going to be more CNG and LNG. But in car and the lighter vehicle, definitely the battery and the charging infrastructure will play important role.
Okay. And coming back to Mr. Revankar, so how do the portfolios behave in terms of individual SRTO fleet? Do they behave in similar manner? Do they behave in different manner?
I think they are all behave in similar manner, because ultimately it is a revenue what you are generating out of the asset that plays a very important role for anyone to behave. So today the utilization level of vehicles are much better, and also the distance covered in a day is much better because of the what you call octroi not being there, interstate tax not being there. So vehicles are able to, and road being much better. Today, on an average, vehicles are covering 400 kilometers a day, which used to be around 250 kilometers a day, 250 to 300. So there is around 25% increase in running per day, and more number of days vehicles are running. So automatically operations are better. So every individuals today, if you ask them, they are all quite happy because of better earning per vehicle. So the credit quality is definitely going to improve, and credit cost will further improve from here, is what I believe.
And Vasumathi, do you think the digital payment infrastructure helped in the collection and maintain the asset quality, especially in the used vehicle, which predominantly had been cash-based prior to the UPI?
Yeah, it has increased in a way the ease of payment for the customer. Right? Previously, when a transporter or a vehicle owner used to go with the vehicle, he didn't come and pay until he came back. Now they're able to use the UPI gateways and pay while they were in the field. The other thing is for an NBFC, it has reduced the insurance costs and the inherent risk with cash carrying that we were doing, and we are able to, in a way, understand why the customer is not able to pay, and the quality has also improved once the electronic payments came in.
Okay. So electronic payment is leading to better quality of business itself.
Yes.
And in terms of, we have a lot of online marketplaces for CB financing. So Vasumathi ma'am again. So do you see price identification being easier and competition increasing in this space because of the online CV platforms?
Yeah, definitely more transparency has come into this segment where the buying and selling is not at the local level anymore. Buyers are able to understand what prices the vehicle are going at. There is competition available, and the sellers are able to get a much better price. And the buyers are able to also understand a similar model vehicle, what price is it going at, so that they can see what price they could get the vehicle at. So more transparency is increasing and more available options are increasing for the buyers.
Oh. So there's an audience question which I think probably Anil Bhavnani ji would be better equipped. So what are the early indications to when the CV cycle peaks out? So what are the early indicators to look at? So right now we are at a growth stage and things look very hunky-dory and everything look very good. But what are the early signs of, let's say, the cycle peaking out?
So I think couple of things, one is, if, like I said, if the government capex on road and infrastructure, we see, slowing down, if new contracts are, not happening, if the metro works, are not happening, dedicated freight road corridors. So I think government capex, because see, India being, a population of 1.4 billion, I think and if India economy grows by 7-8%, the goods and services have to move. And the last mile, I mean, people were talking about, how railways have started moving, Maruti's, 10% of Maruti's freight is now, car carriers are moving through railways. But the last mile can never be done by railways, right? So I think these are clear indicators that, but the day we see, capex coming down, no projects being offered, infrastructure development not happening, metro work not happening, I think that's something, which will break. But currently, I don't see any of these things, happening for the next couple of years. I don't think so. Yes, there will be a shift between new and used because of, the cost of a new commercial vehicle it keeps increasing. So people might buy, a lot of used, for their movements of goods. But overall, I think the industry looks at, these kind of growths are a given for a country like ours.
Okay. And a follow-up question to that. So we have discussed, let's say, government expenditure, etc. We just now described in terms of the key risk factors. What are the additional risk factors of, let's say, regulations or pollution norms or environmental norms? So do you see any signs of those risks being pretty strong as of now?
I look at it as an opportunity. So if government puts, that more than 12 years or 15 years vehicles are not going to ply, in large cities, or 10 years or 8 years, whatever the number of years, and if there's, so you'll have a higher replacement, demand. So that will only increase the demand for new commercial vehicles. So yeah, and so I don't think so any of these things. And like Mr. Revankar was also mentioning, in ultra LCVs and passenger, which is bus segment, we've seen electric vehicles. But for a heavy commercial vehicle, if 30-40%, and I mean their viability only comes, the cost has already gone up. Okay. So hence, like I said, the tenors have moved from 4 to 5 and 5 to 6. So that the EMI levels keep the same. The profitability, will not go up so much. Now, if 30% of the, the weight the battery takes, then the load, they will not be able to carry the same load that they're, coming. So their profit will even come down further. So I don't think some of these draconian rules can, come in without looking at the viability. So I feel the industry will, balance. I think they understand the nuances. I think the segment has the right, people to, talk at the official and government level. It's a well industry which is well understood by the people. I don't see any of these challenges creeping in terms of pollution, environment, and having anything. Yeah, number of years of vehicles depending on state to state, we already have some rules that might impact, which will be a positive impact because it will only increase the replacement of vehicles. So,
so there's a question from Mr. Revankar. What are the potential risks and challenges associated with financing used vehicles, commercial vehicles, and how do financiers mitigate them?
See, there is nothing called potential risk because most of the players who are in the business are well established. They have gone through the cycles and they have understood the cycles. And it's unlikely that anything going wrong unless the Indian economy growth slows down. Like today, we are growing at 7.5% GDP. And if at all it slows down, then definitely there will be less load, more capacity, and viability of the vehicles will come down. Then there will be higher defaults. Unless that happens, I don't think there is a risk per se. Or if there is a drought and factors like El Nino comes for 1 or 2 years and there is a big challenge in the rural area, then things can go out of control. Otherwise, I don't see. And as we other panel members also described, today reach to the customer is better. There's a digital solution for payment, and therefore you don't have your productivity is much better. You can reach customer on mobile. You can send the SMS payment link to the customer, collect the money. So the system has become so efficient that there is a less likelihood of any default or risk unless the macroeconomic factor impacts the viability of the business. I don't really see a challenge there. Maybe as more competitors come in, the margins may come down a little, but lower credit cost will help. And we can, with a lower margin, we can still run a viable, profitable business because the credit cost comes down.
Okay. The next question is to Vasumathi. So, like in the panel, we have discussed that the load has increased by probably 20-30% per vehicle over the last few years. Similarly, the number of days a vehicle plies in a month is also probably increased by 20-25%. And the number of kilometers per day a vehicle has traveled is also increased by 20-30%. So a lot of those variables have now been factored in. So we can't see any significant increase from here, right? Especially in the number of days, etc. So do you see a significant growth in the vehicles itself coming up very substantially because the efficiency gains are now factored in the business and the operation?
Yeah, so the efficiency gains have been factored in. There will be some amount of technological upgrades that will happen with the vehicles where there is no pilferage by the driver or whatever. So there will be some amount of gains from the technological side, especially the new technological vehicles that we have come in. We are just now seeing in the use space because most of this have come in the year 2021. Now they are coming up in the use space. So we will see the gains of that in the use segment now. But so technological gain to some extent will happen, but also with the new vehicle sales being low for so long, and with the increase in infrastructure spending and also the manufacturing involvement where the transportation is increasing there, the demand for new vehicles has gone up, which in turn increases the demand for used vehicles too.
Okay. And so last question to Anil.
It's 5 o'clock.
Bhavnani. So this is an audience question. Do you see the growth in the new CV financing picking up in the immediate future, or you think you initially said that the trend will be between 12 to 15%?
Right.
So should we in the immediate future look at the higher end of the trend, or would it be in line with the current trends?
So, Sanjay, I think, we have this, the Lok Sabha elections, which will happen, between April and May. So the Q1, which is, we might have some subdued numbers coming, but I think, with everything should be put to rest by the first week of June. And I think we should be back to those kind of numbers, as we get over this general elections in the country. So the first 2 months might be sluggish, as it is. April is always a subdued month, but because March is always a big month. And but I think after that, I think once things are back in normal, I think there's no looking back. So anywhere between 12 to 15, because we will obviously not get the full year because of these 2 months of the elections in the country. So there should be some impact of that. Otherwise, I don't think so. I think the growth should continue be in that 12 to 15% range. That's my personal view.
Okay. So to end on a lighter note, the question is for Mr. Anil Bhavnani. So all the panelists have clearly discussed that the CV is probably a reflection of the macro level at the governance overall. And then we see April. April is the month you said is light, but we also see April being the month where the IPL is being played to the maximum, including May. So do you think there's an impact of IPL on the CV sales, or that's another event only the city guys have been following?
No, I don't see IPL have any impact on commercial vehicle. The reason I said April, May will be slightly lighter. April traditionally is always after a big March. April is little sluggish, because March you tend to pull out all stops to get a big number in the month of March, because it's a financial year for all the OEMs and all the NBFCs and all the banks. But and also this year it's also coinciding with our general elections, which is going to happen in our country in the month of April, May, right? So that's the only reason I said it is sluggish, because otherwise IPL has no impact on commercial vehicle.
Thank you. With this, we come to the end of our session. So I thank Mr. Anil Bhavnani, Mr. Umesh, Revankar, and Mr. Vasumathi for attending this, for providing such insightful views. And I hand over the mic back to Divya. Divya, please.
Thank you so much, Sanjay, for moderating the session, and Ravi Shankar for your presentation. Once again, thanking all our guest speakers for their insightful views. It was indeed a privilege to host you. And lastly, thank you to all the participants for taking their time out and for being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now, and I request the tech team to kindly log off.
Thank you.